Welcome to Retirement Mentorship. My name is Freeman. It's good to be with you. I'm a certified financial planner and enrolled agent, which is a tax expert. I run a financial planning firm here in Wisconsin that works with local people and people all over the country. We've got 5 advisors that work with us, and we help a ton of clients. My expertise is all in people getting close to or already retired. So about 65 clients that I'm actively working with, another dozen or so that are currently on hiatus. So when I say that, hey, we want to look at tax effective strategies for brokerage accounts or other things that otherwise impact people getting close to retirement, right? This is all we do. This is what we educate on. And this is what this channel is all about. So today we want to do a couple things, right? A few things. We want to look at some tax effective brokerage strategies, and bear with me for a minute, even if you don't feel like this applies to you. We'll do our questions of the day, right? If you've got questions for us, you can always email us at questions@retirementship.com or drop one in the chat. And then we also have a sketch that we're going to look at. We're going to try and introduce a weekly sketch and just like kind of a quick thing there too. So before we dive into all that though, right, we are in this kind of a series on taxes, tax focus, all that stuff, because it's tax season, and also in honor of our new book, Tax Saving Strategies, which comes out in 8 days. So a week from tomorrow, this will be released on Amazon. You can pre-order it now and get a bunch of goodies for pre-ordering just one copy, and even more if you want to pre-order more than that. So enjoy that. We're going to cover a section of that today, and that's one of the chapters on there. Chapter 5 of this book is on brokerage strategies. So we're going to cover some of the same things that are in that chapter. And if you want to go deeper, grab the book and look at more. So before we dive into brokerage strategies in particular, we first have to, some of these things matter more in brokerage accounts and non-retirement accounts than they matter in traditional IRAs, Roth IRAs, those kind of things. And that is the 2 main ways that you can make money investing. Right. And so we want to get, whether you have a brokerage account or not, stick with it. Like, you want to know this part, right? And the 2 main ways that people make money is you can either be an owner or you can be a loaner, right? Owners are people who own businesses, right? If you invest in the stock market, nebulous stock market, you are not, there's no such thing as investing in the stock market, right? You are buying stocks or ownership shares in the best businesses in the world. And so you are a business owner, right? And when they make money, you make money. When they do well, you do well. And the inverse is true. So you can own businesses or you can loan to them. You can loan to businesses or governments or whatever else, right? So as an owner, you are an equity, stockholder, right? And as a loaner, this is bonds, CDs, and the like. Right? When you buy a CD, you're not really buying a product, right? You are loaning your money to a bank and they're paying you interest. When you are buying a bond from either a government or a business, you are lending your money to that government or business and they are paying you interest on that money and then giving you your money back, right? If you buy a bond fund, you're putting money into a fund that just loans it back out to corporations and governments. And so these are fundamentally the 2 ways that you make money. This way is more guaranteed and much lower overall. Being an owner is not as guaranteed, but is truly the best way to build wealth long-term. As you know, I call myself an equity evangelist, right? I am out here declaring the good news of owning the best business in the world, owning stocks, owning equities. And so that is a better way. It's the superior way to build long-term wealth than, right? And the one way to think about it, right? You've seen like the rise of Apple, you've seen the rise of Google, all these things. Would you rather own Apple or have just lent money to it over the last 20 years? And obviously, we'd rather be owners of Apple than lend money to it, right? And obviously, for every Apple, there's a bunch of other ones that didn't do as well. We get that. That's why we diversify, etc. But truly, being an owner is the best way to build wealth. So, but with that, right, if you're in an IRA or Roth IRA, 401k, there's no real tax difference between these 2, right? There's a rate of return difference, right? Typically, being an equity owner is going to, average, 8 to 12% annually, and investing in fixed income is going to be maybe 3 to 5%. So there's a rate of return difference in investing in these and being an owner or loaner in retirement accounts, but there's not a taxable difference. It's all taxed the same way. Well, that's different in a brokerage account, in a non-retirement account. So we want to talk about, hey, what are some strategies to be tax effective, tax efficient in these accounts. First, I want to cover, hey, how are these things actually taxed? Because we need to know that. If we want to avoid taxes, we need to know how we are taxed. Knowledge is power. And and after that, we want to cover 4 different strategies you can use to save taxes on these accounts and invest more tax effectively. So first, how are these accounts taxed? How are brokerage accounts taxed? There are 2 different ways that you can get taxed. There is ordinary income. This is anything that you pay your normal tax rates on, right? So you think about the tax brackets. You have the 10% tax bracket, 12, 22, 24, etc. So all those would be that's their ordinary income tax brackets. And so ordinary income would be anything that would hit those tax brackets. The other ones are your capital gains tax brackets, right? And that is either 0, 15, or 20. Those are the capital gains brackets. So we'll come back to that, right? Anything, and there's a bunch of different things that hit inside of here. So your earned income, money that you earn from a job, that's a subset of ordinary income, right? You've got the bigger ordinary income, and then inside of that you have, earned income, and then you have, interest income. So any interest you make from loaning things, bonds, CDs, high yield savings accounts, etc., that would all be in there. You've got dividends, ordinary dividends, and you've got short-term capital gains. Would all be inside of here. CG, there we go. All those different types, and maybe some other ones, would all be considered ordinary income and be taxed at that rate. Capital gains, on the other hand, would be things that are taxed at lower rates. Is there an E in capital gains? Capital gains? I don't know. I don't think there is. Capital gains. There we go. And so this would be 2 different things mostly. It would be your long-term capital gains would be one bucket, and then qualified dividends. So what is the difference between short-term, long-term, all those things? So if you buy something for X amount and you hold it for 1 year or less, right? So you're on this side of the 1-year mark. So you buy it for this, it grows to here, right? And so you've got this gain on here. If you own it for less than a year, this would be short-term capital gains. And if you own it for more than a year, then it's long-term capital gains, right? And so a really key point to all of this is just understanding cost basis and gains, right? So whenever you buy anything for anything, what you bought it for, I guess I'm kind of out of the frame there, what you bought it for is your cost basis on anything, right? So that's how much you paid for it. That's how much, and since you already bought it with after-tax money, you will never pay taxes again on your cost basis, on what you paid for it. And so anything above your cost basis is now capital gains. And so if you sold this here, right, you have a little bit of a gain there. So you would pay short-term capital gains on just the difference between what you paid for it, your cost basis, and your gain. If you held it for more than a year and then you sold it somewhere out here, right? You sold it here. Since you're beyond a year, you would now have a larger gain, ostensibly, but that would be a long-term capital gain just on the amount that's above your cost basis, right? So that's really important to know. And so again, if you in a Roth IRA or a traditional IRA, or let's say a traditional IRA, if you bought something at here and it grew to here, you just pay ordinary income on that. Because here'd be another one here, any retirement distributions are all going to come out at ordinary income tax rates, right? Roth conversions are at ordinary income tax rates. So it doesn't matter what your cost basis is, you pay ordinary income. But it really matters in non-retirement accounts because, again, this part is always going to be tax-free because you already paid taxes on it, and only on the gains will you pay any taxes. Okay? So we've got kind of different things that fall into each bucket. We've got kind of how it's taxed between cost basis and gains. And again, if it's short-term, it would be under ordinary income. And if it's long-term, it'd be under capital gains tax brackets. Then we also have, right, if you're a business owner, there are 2 ways to make money, right? If you're in this camp here, we break this down. You've got appreciation, which again is you bought it for appreciation. I'm just going to put a dot on there. Appreciation. You bought it for X, it grew to Y, you sold it, and you got that gain. The other way is, of course, dividends. And that is where the companies make profits and they pay that to you, the owner. And so you get those. Those usually paid on a quarterly or semi-annual or annual basis, right? And so how those are taxed depends on what kind of dividends. There's ordinary and qualified. Ordinary dividends, they usually pay those. A lot of times, like foreign companies will pay ordinary dividends, or if you haven't held it long enough, it'll be an ordinary dividend, kind of in that short-term vein, right? So there's a bunch of stipulations on what makes it an ordinary dividend, but those would be at ordinary income tax rates. And if it's a qualified dividend, you are taxed that at capital gains rates, which is much more favorable, right? And so there's all the different types of. So we got multiple things. We got ordinary versus capital gains, long-term versus short-term, capital gains versus dividends, interest, retirement distributions, all these different things. So there's lots of different parts to this. And if you're like, wow, I hate all of these things, hire someone to do it for you, right? But if you want to save taxes, you need to know how. And if you want to save taxes and not need to know how, then you need to hire someone who knows how. Either way, someone needs to know how so that they can actually implement these things for you, whether it's you or someone else. The other thing with brokerage accounts that matters that a lot of people don't know about is what's called your net investment income tax, or NIT, which is, hey, if you make more than basically $250,000 if you're married filing jointly, and I think it's like half that if you're single, then any investment income, right? Investment income is taxed at an additional 3.8%. So you'd pay maybe your 15% capital gains, but then you would also pay an additional 3.8% on that money. If you have interest that gets pushed above that line, that's also going to get, even though you're paying ordinary income taxes on that, you're also going to get the 3.8% on that as well. And what's interesting is you get taxed on either ordinary or capital gains on your taxable income, but this amount here is your adjusted gross income, which is a separate number. So it all gets kind of jumbled. And again, it kind of becomes a lot to keep track of, but it is possible. And it really matters in terms of saving thousands of dollars per year by using the right strategies. The other thing that's important to realize about all this is the whole concept of what's called like income stacking. And so I've tried to explain this in like workshops and stuff, and it's kind of hard to explain, but came up with what I think will be helpful for understanding how income stacks and how this works. And so here's your tax brackets, right? And so anyone who makes income, right, the first chunk of your income is going to be taxed at 0% because we have a standard deduction, right? That's like $32,200, I think, for 2026. An extra $2,000 if you're over 65. If you qualify, you might also get a senior bonus deduction if you're over 65 and have a low enough AGI, right? And so some amount of money, 32,000 or more, if you're a couple, is going to get taxed at 0%, right? So the red over here is going to be your ordinary income tax brackets, and the blue over here is going to be your capital gains tax brackets, right? And so then after you get over that number, you would pay 10% on a chunk, and then 12% on a chunk, and then up to 22 for everything in here, 24, and then it keeps going up into other brackets. The other important thing to note is that for capital gains, the point at which it crosses from a 0% capital gains bracket to a 15 is almost the same point where your taxable income goes from 12 to 22. It's like a couple $100 off. I don't know why they don't just make it the same number, but it's really close. So you can mostly just think it's the same number. Again, if you go over either of these brackets, you only pay the 22 and 15 on the amount that's over it. It's not like it makes it all taxable. So it's not a huge deal if you go over these brackets. That's not the same to be true of the income-related Medicare adjustment amount, IRMA. That's you go over $1 and you pay the whole amount. So, but for these, since they're tax brackets, it's a graduated phase in there. So, those are your brackets. And what can happen is we're going to use water to represent just ordinary income, right? Like just stuff that you would earn, right? So let's say you're retired and you are starting out the year, and as the year goes on, right, you've got some pension income that comes in. And maybe you've got, $30-something thousand of pension income for the year. Well, perfect. Well, all that's going to fit inside that zero tax bracket. So maybe if that was all the income you had, you would pay no taxes on that at all, right? Because it's all at 0%. But then you also have a bunch of Social Security income, right? And some of that becomes taxable. And so we're going to dump some more water in there, and maybe that fills up your 10% tax bracket. But then maybe you've got some, then we have maybe you got a big brokerage account, right? And then some dividends pay out. And here's part of what happens, right? Is that it's not like you earn all your dividends, all your interest on December 31st. Like these things pay throughout the year. You earn some income and you make some dividends and you make some interest, right? But what happens is that if the oil here is our capital gains and our interest and all that stuff, or I guess it wouldn't be interest, capital gains, qualified dividends. Those are going to rise to the top, right? And those are always going to stack on top of any ordinary income that we have, right? So if we pour some in at the beginning, it's going to get there at the top. And so, yes, we're still only paying 10% on our ordinary income, right? And we're still underneath the tax bracket for capital gains. So we're still paying 0% on all those. But now let's say that we take an IRA distribution because we want to go on a vacation, right? And that kind of mixes it up. And maybe it's hard to tell where we're at and whatnot. But when all the dust settles and it all separates out, we might still be able to just perfectly nail it so that we keep our ordinary income underneath the bracket. And we also keep our capital gains underneath that tax bracket as well. But if we're not paying attention, right, we can say, hey, look, I still have a whole bunch of room left in my 12% tax bracket. I should do a big Roth conversion, right? And so you do a big Roth conversion, trying to get to the top of that 12% tax bracket. Well, what that did was it pushed all of your capital gains now up over from the 0% tax bracket into the 15, right? And so that Roth conversion didn't just cost you 12% in ordinary income on the conversion itself, right? It also costs you 15% on all of this capital gains that you pushed into the next tax bracket. So 12 plus 15, you actually got taxed at 27% on that additional Roth conversion. And if you're taking Social Security, right, it probably, since the amount of your Social Security that is taxed depends on your other income called your provisional income, it probably made more of your Social Security taxable as well. And so we'll just pour some of that in there. And since it made some of that more taxable, it pushed the rest of your capital gains up there. It pushed you down to the 22. And so again, that Roth conversion may have cost you way more than 12. It could have cost you 27, 29, somewhere in there, some absurd amount of money based on how your income actually falls. So hope that makes sense, right? Maybe you've got some more capital gains than that, some more dividends that came in at the end of the year that we forgot about, right? Those are also going to stack, go to the top. You did another Roth conversion, etc. And so that's kind of how that works, right? And so you might, again, be able to keep your ordinary income under a certain tax bracket, but we need to look at how does this work and how does it compare with everything else as well. That makes sense? If that helps kind of visualize, let me know if that helps understand kind of how that stacking works. Maybe if you throw that in a comment, we can just kind of test out and see, hey, is that helpful for future things? So that's how that works. We need to know how much we're going to earn ahead of time, do some good estimates, do some good tax planning for the year so we can see these things. And that's how we will avoid it. So if you want, again, we're here live at 4 o'clock every Wednesday, 4 o'clock Central. And so if you want to be able to comment live, ask questions live in the thing, we're here. We're always going to have this main topic, right? We'll have a Q&A, chat, etc. So we'd love for you to join us live. And of course, it'll just repost both to the YouTube feeds and to some podcast feeds after the fact if you'd rather listen or watch later. The primary Apple podcast feed, and I think Spotify too, is a video, a vodcast. You can listen to it, or you can pull your phone out of your pocket and go to landscape mode, and it should switch over to video. So as I'm doing a visual demonstration like that, you can always view that as well. Okay, so that's kind of the baseline of how all this stuff is taxed. I want to make sure I don't knock this over because that would be something. We want to. But now, what about these actual strategies, right? How do we pay less in taxes? How do we do the different strategies that we want to do? So we'll get some more paper over here, as before. And so there's 4 strategies. I'm going to list them out real quick, and then we'll go through each one, right? So the first one is asset location. Then we have tax loss harvesting. Harvesting, there we go. And then we have tax gain harvesting. And then we have step up in basis. There's other ones too. We talk more about some of them in the book, but these are the 4, 1, 2, 3, 4 that we're going to go over today. So if you're watching this live, great. Again, put some comments in there. If you're watching this after the fact, it might bookmark different things. So if you're more interested in one versus the other, you might be able to skip ahead and see where those are at. So first of all, asset location. So certain assets produce one type of income over another. And so in a totally diversified portfolio, right, across retirement accounts and brokerage accounts, you might have all sorts of different asset classes, right? But where you keep those different asset classes and which type of account really matters. And that's what asset location means, right? So for instance, if you have a ton of bonds and those types of things, right? You might want to say, hey, do we really want all these bonds in a brokerage account where they're going to be producing taxable interest? Or do we want more of those in our IRA where it's going to defer those interests so we're not getting taxed on it every single year, right? If we have so a lot of ordinary income type investments, you'd want those to go in an IRA, and a lot of capital gain type investments, those you might want to have in your brokerage, right? And so, and it matters between the types of accounts you have. So let's say that you are investing in equities, right? You got a bunch of equity mutual funds, right? Well, some of them will produce more ordinary dividends, and some will produce more qualified dividends, right? And so you want to know which one is which. And so if you're going to say, hey, let's say you want to try both passive investing, just index funds, and you want to try your hand dabbling in active investing as well, where you pay a higher expense ratio and the managers try to beat the market by buying and selling, right? Well, active funds are more active. They're selling and buying way more often. What you're looking for is called the turnover. And if the turnover on the fund is high, that means they're doing a lot of buying and selling inside the fund. And so even though you didn't buy or sell anything, since they were doing it in the fund, they still pass on those gains or those losses to you. And so you might actually get a whole bunch of ordinary dividends from your active investments because because they are turning them over all the time and they don't hold them long enough to turn them into qualified dividends. And so your active funds, right? Active, we would want in your IRAs, and your passive funds, your index funds, whatever, those you would want in a brokerage account, because then again, you can control how it's taxed and you can get the much more favorable capital gains rates in the brokerage account with these types of assets and defer all that ordinary income and let that, right? Because either way, if it produces these dividends, it's going to reinvest them, right? And so we might as well not get taxed on them in an IRA and instead of getting taxed on them in a brokerage account, right? The other thing you would want to look at, so right, which accounts like bonds and stuff just produce ordinary income all the time, active versus passive equity funds, and the last one would be like growth versus value, right? Growth funds are companies generally that are trying to continuously raise how valuable they are. They really want between your appreciation, your dividends, they want more appreciation, and so they usually pay a lower dividend amount, and they have a higher just price rate of return, right? Again, we only care about total rate of return. That's the main thing we care about, which is appreciation plus dividends. There we go. These two together is total appreciation, and that's what matters most overall. But again, if we say, well, hey, we want a lot of growth funds and we want some value funds, well, value funds tend to churn out more dividends. If you're not using them, you would probably just want them and they're just reinvesting. We probably want that in an IRA, right? So we do our value funds over here, and we would do our growth funds over here, because these are going to pay less dividends, so there's less to be taxed each year. And these ones, you're going to reinvest them anyway, and so you want them just sucked up in here. Now, the opposite is true. If you're living off dividends, hey, we want this money anyway, then instead of them generating dividends in here that are then going to be taxed at ordinary income, maybe we actually want our value funds over here, because we're going to live off those dividends. And so we actually want them paid out to us. And so I'd rather earn dividends and pay them at capital gains rates than earn dividends and pay them at ordinary income rates in your IRA and take it as a distribution. Does that make sense? So depending on where you are at, it might actually flip the growth value spectrum, depending on what you're trying to do. And so that's kind of asset location, right? Where you keep your different funds and how they're taxed, which accounts you keep them in, can make a big difference in how much in total taxes that you pay. Okay. The next one that we want to cover, next strategy, is move some of this over, some more space. A little bit more. There we go. Is your capital loss harvesting, right? So again, let's say that you invest at this point here. So let's say you put $100 in or $1,000, and so again, that is your, what is this? That's your cost basis, right? You will never pay taxes on that again, right? And as equity funds do, right, it's going up and down in value, right? And what can happen is every once in a while, right, we have bad markets and the value goes down, and we can just wait on it and let it, come back and do nothing, and eventually it'll go on and make great heights. Awesome. But instead, what we might do is we want to say, hey, why don't we sell here? You're not going to perfectly at the bottom, but even here, wherever else, let's sell while it's low. Let's capture that loss. Because what can happen is, let's say this went down to, and we'll just do 500,000 just to make it, or 500 just to make it easy math, right? So we bought it at 1,000, we sold it at 500, and what can happen is that loss you get to take. So you're taking a $500 loss per share, right? And that loss can be applied against ordinary income up to $3,000 a year. And so we can say, hey, we have a loss. That's true either way. We can take advantage of that and write off up to $3,000 against whatever tax bracket we're in. So it may be the 22% tax bracket, and we can save several $100s in taxes that year. Now, we don't normally just want to take losses, right? So what we're doing with that is we are then buying something else at the same, that's also down in value. So we sell something that's 40% off and 40% down, and we buy something else that's also 40% down, so that, right, we can ride that back up. We're not in this to take losses. We don't want to take losses just for the sake of saving taxes. We want to make money. We want to pay taxes because we made money. But we'll buy something similar. It can't be too similar, otherwise they'll disallow it. It's called a wash sale rule. Look into it. But we buy something similar, it's also down, and ride that back up with the recovery. And now our cost basis is down here. Right now, eventually, when you do sell that, you're going to pay it. If you sell it here, you would have paid this as a capital gain, but instead you're paying this as a capital gain. So you have a larger capital gain. So you're not totally getting rid of the taxes here, because you're still going to pay it, and you're going to pay more capital gains later. And that's why tax loss harvesting gets a little overhyped. It's not as good as some people think it is, but it's still great because, again, going back to our chunk here, right? If you are selling and avoiding 22% in ordinary income, yes, you might eventually pay 15% in capital gains later, but you're still saving that difference in taxes, right? And maybe you're saving 22% now, but in retirement, you'll be in the 0% tax bracket. So even though you have capital gains later, you'll actually pay nothing, and then you really are saving a true 22%, right? Or if you're in 12%, you'll pay 0%, and it's still at 12% gain. So you will eventually pay more taxes later on the capital gain, but it is less overall than not doing that. So this is a good way to turn a tragedy into a triumph by, at least, yes, it's going to recover either way, and at least we can save some taxes along the way. The inverse side of that is your capital gain harvesting, which is to say, hey, if we're in an advantageous bracket anyways, and usually where that's at is people are, right, they're like here-ish, and we got a little bit of gap between here and the top of the bracket. Well, what we might say is, hey, we bought, again, we bought here, and now we're way up here, and why don't we sell it, capture the gain, right? That gain now goes on our tax return, but it's going on at 0%, right? We have some things going on in the future where we might need money and we want it tax-free, so let's capture the gain now where we can pay nothing on it, and then that resets our basis up here. And so that later on, when we sell it here, now we only have a capital gain on this amount instead of on this amount, right? And then we can pay less in taxes there. So that's kind of like really the flip side. It's really not any more complicated than that. This one, you don't have to worry about wash sale rules or anything like that. You can literally just sell it and buy the exact same thing again and just keep riding it. But that way it resets your basis, capture that gain while you pay 0% taxes on it. And then later on, you either don't have to pay as much, or it just gives you more flexibility in what you can pull out. So always good to save taxes when we can. The last part is, and we'll just do another table for this one, right? On our taxes here, right? On things that we buy, on brokerage stuff. Again, if you buy something for $1,000, that's your cost basis, and that might go up and up and up and up and up, way up, right? And if you sold it here, again, you would pay taxes on all of this chunk, or that'd be your capital gain for the year. But if you die right here, and instead you give it to someone, they get what's called a step up in basis. So it's like, instead of them paying this amount on it, it's like they paid this amount on it, right? And so if it goes from 1,000 to 3,000, now the IRS sees that they paid 3,000 for it. And if it goes up a little bit more and then they sell it here, they're only going to pay taxes on this tiny amount instead of this huge amount. Right? So for a lot of people, it makes sense to hold on to real estate or or stocks and a brokerage account, all those things, so that they can get that big step up in basis. Because again, you're not paying taxes on all this all the time, only really when you sell it. And if you just wait till the end, you get a step up in basis and your heirs will pay nothing in taxes, right? Now, again, we don't want to let that stop us from doing the right thing. There's some people that are holding on to terrible investments just so they can get a step up. But if we can, obviously there's a big difference. If we're gonna pass away in the next couple of years anyways, don't sell it, just hold on to it and get that step up in basis. Another big thing, right? We cover this in chapter 3 of the book on terrible tax strategies. And we talked about that in a few videos before. Again, this is where things like non-qualified annuities, which will defer all your taxes and you won't pay any capital gains on it at all, they don't get a step up in basis. Your heirs will pay all this gain, all at ordinary income tax rates, right? And so that's where sometimes brokerage accounts, non-annuities, can actually be more tax advantageous than annuities, right? So there's just 4 quick ways that you can, asset location, what types of investments you keep in what types of accounts. That's going to matter. Taking advantage of losses when you can, taking advantage of gains when you can, and leveraging that step up in basis. All those kind of short-term things, right? You can change your asset location today potentially. Your capital losses, capital gain harvesting, you just have to be ready for those. So you need to know about them in advance so you can do them if the opportunity presents itself, right? And step up in basis, that's a long-term planning thing. Hey, how are we gonna handle this long-term to take advantage of that? So hopefully those are helpful. Again, if you want more tax saving strategies, we have a bunch of those in the book. You can pre-order it now and you get some goodies for pre-ordering. Otherwise, it'll be available a week from today on 3/26/2026. So yeah, there we go. Okay, a couple of quick things. We're going to now do a new section of the show that we call our sketch of the day, or we might workshop that name. But if you follow me on, if you're part of a retire membership, right, we'll get a whole bunch of stuff for people who just want to give us their email. That's all we require, right? You can become a retire membership, and we get a whole bunch of different content that you only get if you are a retire member. One of them is a weekly email, and I have sketches like this and a little commentary, so it's a really quick read. But we're going to cover some of them just in a different way on the YouTube as well. So here's an example one, right? Investor versus investment reality. And so often we think, right? Let me get a different color for this. Let's do pink. No, let's do yellow. I don't know if this is going to show up. We think, right, that when we hear, hey, it goes between 0 and 10%, like, hey, we're gonna get 9%, and then we're gonna get 11%, and then 5 and 8, and maybe every once in a while we lose a couple. And we just kind of think in our back of our minds to think that this is how investing works, when really it doesn't work that way, right? It works more like this, where you have good returns, blah returns, terrible returns, excellent returns, a whole bunch of really good returns in a year, then a bad one, and just when you think it's going to go worse, nope, it goes the other way, and then that little blip, and then a whole bunch more good returns, and then bad ones, and it's all over the place, right? And so even now, as we're in 2026, right, and there's the war in Iran is going on, all these things, we don't know how this year is going to shape up, but I've said that about basically every year. And as we're doing client reviews right now with our clients, and we kind of say, hey, it's kind of a weird start to the year with the market. But I'm like, man, I've said this like a bunch of times in a bunch of different years, right? And so it's always this way, right? Where just when you think it's going to be stable, average earnings, but it's not. And the only way, right, to get this nice long-term 10% average, 8 to 12% average, is to stay invested, to be good business owners throughout all of it. And that is how you build true wealth. So again, ditch the expectation that you're going to have stable returns. Realize that you're going to have the roller coaster. The only people who get hurt on a roller coaster are the ones who jump off. So stay the course, stay invested. Hopefully that little blurb is helpful. Okay, and then on to our question/comment of the day. I did get this one from, there was someone who commented that, you like financial advisors will be out of a job in 3 years. I can do everything with AI. And so I just want to riff on this for a second. I like AI for the most part, right? I use it a lot in different things. And right now, I definitely would not trust it to do financial planning. I try using it to check things like tax law and look up things, investments and all that. And it hallucinates is what it's called, right? Makes mistakes a lot, like something like 20% of the time. So you ask it like a tax fact, and it will be 100% certain. Like, here it is. Here's the rate. Here's how it's taxed. And it will just be dead wrong. because it's pulling from information. Sometimes it's pulling from like it'll pull from an article that's 3 years old, but the new tax law wiped it out, right? But it's not pulling from a more recent source. And so it what it says maybe was true, but isn't true anymore. And so I would be very cautious on taking full financial advice from AI right now. Now, I also recognize that that's probably temporary, and they'll get better at that. And AI is going to keep improving, and eventually you're going to ask ChatGPT or Gemini or Claude or Perplexity or whatever else. Or you're going to be able to ask it questions, and its hallucinations are going to be down to 1 or 2%. I don't know if it'll ever be perfect, but it'll get really good. And some people have argued, well, hey, advisors probably make mistakes 1 or 2% of the time too, so that's about the same, and that might be true. And so I think that can be great, but AI is still going to be the same as trying to do your own planning with like DIY financial planning tools, right? Or doing your own taxes, in that it's only as good as the input you put in. That's it. If you don't put in all the right context and all the right information, it's going to give you a good answer for what you gave it, but you were missing a lot of key context, right? And so, for example, like I don't personally like using email. I get tons of emails, and I don't like spending a lot of time in it. And some people say that they dash off. Some of my clients will just dash off a simple question to me, what they think is a simple question, but it'll take me like 20 minutes to answer it. Why? Because if you just needed a simple answer to, hey, what's the standard deduction this year, you can just Google that, right? And I could just tell you if that was your question. But a lot of times it seems simple, but I have to go back and review all their stuff because I need all the context of all the client's information to say what they should do, right? Even just today, so a client had emailed and said, hey, I need $20,000 fast for an emergency, right? And I wasn't just like, yeah, done. Here you go. Here's your 20,000, right? I have to go quickly finish off their tax projections, see which accounts to pull it from. Then inside of there, which assets should we sell if they're up or down or sideways, all these different things, right? And so it still took us 30 minutes to make sure that we identified correctly, and we did. And like the initial thing would have been wrong, and we would have cost them a bunch of taxes. But by taking more time and applying all that context to them, we were able to pull it in a way where they actually say, because you want to do it out of one account, but we actually it'll save them like $1,500 by doing it the way we did it instead of the way that he initially kind of asked for it. And so that context, knowing all that stuff, and that really only comes from going real deep with clients so we understand everything they have going on so that we can give those thoroughly correct answers when people ask stuff. And if you just say, hey, what's the best investment for me as a retiree? It'll spit out an answer, but it's not really taking everything into account. And so I don't know that you're ever going to get to the point where you as a person, not that no one can do it. There are some people who can do their own financial planning fairly successfully. But I think the average person does not want to know enough about finances to make sure that they're putting the right prompts into AI to get the right answers back, right? And lastly, I would say, right, that if the market's down 40% and clients have seen their $1 million that took them a lifetime to accumulate drop by $400,000, and they ask AI, hey, should I sell? And AI says, no, you should stay the course. I'm not confident that some words on a screen are going to make people do that and avoid making the biggest mistake of their life, which is to panic and sell low, right? But a real person would have a much better chance of doing that. And so you can save all the money in the world on not paying for financial advisors and whatnot, because you can do it for free on AI. But if you make even one mistake, the stakes are pretty high when you've reached your pinnacle life savings. And I'm not sure that the marginal savings, either just the little things that real professionals can do, real experts can do for you, and let alone helping you avoid some much bigger mistakes. I'm not sure that's going to make up for those savings. So I'm glad that that AI is giving more resources to more people and they can do more with it. I don't think that real financial planners like myself and many others will ever get replaced. There'll be a whole bunch of garbage, like financial professionals who just sell stuff and don't really know anything, and they'll all be out of a job and they'll be replaced by AI, and that's fine. But I think the real planners that know people, know all the context, are a real person that people can talk to, that you can sit across, look in the eye with, have a conversation. And I don't think we're really in danger of being replaced. So whatever that's worth, definitely use AI. It's awesome if used in the right way. It also can be dangerous. And so I hope it keeps getting better. I hope the hallucinations cut down because that'll help me out. But I'm not really worried about it. So I disagree with your out of a job in 3 years. So we're here for you if you are close to retirement or in retirement, right? My whole goal is to be your retirement mentor, right? Retire mentorship, your mentor to and through retirement, helping you retire successfully and stay successfully retired. Hope this has been good for you. We'll see you again next week, and stay the course. Cheers.